Hi, this is Raghee Horner, and welcome to the second part of our system and EA and custom indicator mindset development. We're not getting into the actual programming. That's not something that we're really going to do in this month. In fact, what I'm going to probably really get to is get to the point where, for those of you that are interested in programming, I'll give you some resources. That's not my interest, but one of the things that you want to remember is there is a mindset to the development. There has to be an understanding of the underpinnings of the market, psychology, and the different trading types that we're going to try to automate. And the analogy that I used last month was an automatic and manual transmission. Okay? For me, what I want to do is automate the best of myself. And that means removing the emotion, the fear, and the greed from the process and taking the steps to which that I have a setup for swing trading or momentum trading or trend reversals or range-bound trading, and break it down to those steps and see if there's not a way to take the strategy and automate it. One of the things we talked about last week also was the challenge of understanding which type of approach is ideally suited for the particular environment that you're dealing with on the time frame that you're trading. These are kind of towing the line of discretionary analysis, but at the same time, I think it's one of the fundamental flaws of thinking that one system or one strategy, whether it be the automated system type mentality, whether it be the allure of a single custom indicator or EA, or whether it be the discretionary trader thinking that one type of approach is going to be able to tackle all the different market types. That's probably the biggest fallacy, I think, from my experience in the market. So we talked a lot about that last week. So what we're going to kind of move on to now is breaking down that discussion into smaller particulars. And I'll admit it's a challenging subject because for me, I'm not a systems trader, so it's kind of an unusual thing for me to be talking about systems trading. But what I hope that you remember throughout the next 2 months is we'll still talk about the current market. We'll still talk about different strategies that I use to manage your current market. And what you're joining me for is my own journey into systems. I don't know that I'm going to become a systems trader. I don't want you thinking that at all. I'm just curious if there's a way to take what I do, allocate a certain part of my time and account to this. I think after being in the markets now for all these years, it's just another part of, I don't want to call it an evolution, because I don't want to leave the impression that this is the next step for a trader. I'm curious. I kind of look at it as a move that is a lateral move, because I don't want to imply that discretionary trading requires evolution. That somehow a discretionary trader, if they are to advance as a trader, must at some point become a systems trader. I don't want to imply that at all. This is just my own curiosity, okay, and taking this idea that, can I take what I've been doing and cookie cutter it? Can I be me in terms of an EA or a system, and let that version of me, let that coded version of me do some of the work? At times that I may not be available, at times that I may be distracted, or at hours of the day that I'm simply not going to be trading. Maybe it's going to be in pairs that I don't typically watch or have the time to watch, so I might let an EA like this go to work in a cross trade or something. I don't know how that's going to be. I think we're going to discuss it as we progress along our journey here. Okay, so again, if you have any questions, please feel free to type them in. And let's go ahead and talk about today technical trading approaches. And all you're seeing right now is that original slide, okay? And we'll get to the charts and so forth momentarily. So first things first, technical trader approaches. Let's define what technical trading is, because I think a lot of people think if you use a chart, you're a technical trader. And to me, that's not necessarily the case. Technical trading to me is a certain reliance on indicators. Okay? So this fascination with indicators that we all at some point have, and I like indicators. I mean, a wave is a series of indicators. They're exponential moving averages. Those are indicators. Okay? In terms of understanding how and when to focus on technical indicators, there are so many. We need to go back to understanding market trends, because certain indicators do well in different market trends. I'm not going to rely on a set of moving averages in a sideways market. That's not the environment they thrive in. But in a sideways market where I think exhaustion could be ruling a wide range, a stochastic is perfectly designed to handle that environment, in my opinion. If I'm looking for if I'm looking at a sideways market environment that's narrow and I'm waiting for momentum to reveal itself, I think an MACD histogram is a great way to confirm the momentum. So I've not only coupled certain indicators with certain trading styles, but the trading styles are based upon the underlying market trend. Okay, and that's going to be the one thing that we're going to continue to discuss throughout this journey. Okay, so a technical trader, let's just again define it. They use technical indicators, like I mentioned, and then they'll combine that with some personally defined sets of steps and guidelines, maybe rules under which the technical indicator and price helps them enter and set profit targets and stop losses. Okay? I think a lot of traders go from winging it, which I think a lot of people erroneously consider discretionary trading, but I think a lot of traders who get into technicals realize that they need some sort of way to begin to remove emotion. Think about indicators for a moment. I think it's the first baby step that a lot of traders take when they begin to realize that they need a way to remove emotion from their process. And I think the technical indicators then become a way for them to do that. Okay, that's kind of been my opinion about technical trading from the standpoint that it's a process by which traders realize that without some sort of systematized methodology approach, they're going to be winging it to a certain degree. So let's head on over to the platform here. All right. So you'll notice right off the bat, I've got 4 windows. Hopefully you're used to this from our typical webinar presentations. And in each window, I've got an indicator. Now, these are my chosen indicators. MACD histogram, which is the MACD traditional that Interbank FX makes available on the Interbank FX Trader 4 platform. I've got a stochastic here, which is a little unusual looking for a lot of people. I have a unusual way of putting it. A lot of times on my stochastics, I'll actually do the 21-3-1 to just simplify the visual. But let me show you also what a more conventional view would be. There's more of a conventional view. Okay. I'm less interested in the crosses and more interested in the over 80 or under 20 reading. Okay, and then we have the CCI here. So with these 3 indicators, what I essentially have is an approach that, or is a visual of the 3 types of indicators I would use depending upon the market environment and the trade setup that I'm looking to confirm. Okay? So each one of these indicators has an underlying environment under which I will consider each one of these individual charts. So if I'm looking for a momentum breakout or breakdown, The technical aspect of my trading, okay, would take me to the MACD, which would confirm the momentum out of a sideways range. So first, what are the steps here? First, I would need some sort of sideways consolidation. For those of you that use the 34 EMA wave, which of course is an indicator, you know that I want to see it in a flat 3 o'clock angle. Okay? And then if I can get some sort of pattern, perhaps I'm going to use the Interbank FX PRS program and look for a triangle or a rectangle or a pennant. And if prices are able to break out or break down from that pattern, from that consolidation, I'll use the MACD to confirm the momentum. You know, that's classic momentum trading. So by understanding what the steps of my approach are and then recognizing the technical aspect of that approach, I am in some ways at that moment within the steps of my trade relying on being a technical trader. For me, though, it's usually the very last step. So as I'm going through my process of perhaps systematizing a momentum trading setup, you know, part of recognizing a sideways market, one that we had recently was the consolidation before the breakdown on the dollar-yen. Okay? One of the ways that I recognized the sideways market was not just a flattening wave, but also the introduction of blue neutral grab candles. So perhaps within my system, the first step is going to be when there are more blue. You know, what is more blue? If I'm going to try to systematize it, if I've got a look back of perhaps 60 candles, what percentage of those candles has to be blue for the market to be a sideways consolidation or congestion? You know, that's one way to think about systematizing something that we now look at in a discretionary manner. You know, so I look back on, say, 3 months. Perhaps that's my look back. And I say, well, how many of the candles were blue? And if a certain percentage of them are blue, perhaps that's enough to define a sideways market. And then at that point, if a significant higher low is taken out and the MACD confirms a momentum, so for me, if prices break down through support with a negative MACD reading, that's a momentum breakdown and a short entry. If prices take out some sort of significant high or a downtrend line resistance accompanied by a positive MACD histogram reading, that's a momentum buy order. You know, again, we're taking what was discretionary and injecting some technical analysis. In this case, the most obvious is the MACD histogram itself, but don't underestimate that even though it's a little unorthodox, the grab candles are a version of technical analysis as well. Okay, so I'm definitely not poo-pooing technical analysis. But again, I want to recognize that it's all within the context of a certain market environment. So the MACD isn't simply something that I use because I just want to execute a trade using it. It's used to confirm the momentum as prices are consolidating and perhaps will break out of that consolidation. Okay? Now, what about another indicator? I alluded to the stochastic earlier. Okay? The technical aspect of my trading that involves the stochastic is one that relies on a sideways market trend that is in congestion, preferably in an environment where there is some sort of definable high and low off which I feel that the sideways congestion is likely to exhaust. So I think a stochastic is perfectly suited to identifying or confirming, I should say, not identifying. The price should identify where the exhaustion is going to be, but the stochastic could confirm that exhaustion. In other words, something is overbought or oversold. But within the context of a trend, let me ask you, within the context of a trend, is a stochastic ideally suited to recognize overbought or oversold? Not in my opinion. It's an oscillator, right? A stochastic is an oscillator. I think most people would agree with me, right, when I say that. So what do I need an oscillator to define? An oscillating market, correct? So that's where I want to take an indicator like a stochastic, combine it with another sideways market. This one should be distribution or congestion. Identify the floor and ceiling of the congestion and try to fade or sell into the ceiling and buy into the floor. Okay? Now, what's the technical aspect of that trade? The stochastic itself confirming that a market is likely to exhaust. But again, that stochastic has to be used within the context of that wide volatile range. The wide volatility is what leads to the expectation and the likelihood of prices exhausting at the ceiling or at the floor. Okay? Now, let me mention here, I think a lot of people want to believe that somehow indicators lead price action. And I'm not, obviously I'm not here to begin any kind of argument, but the word leading to me is misleading, in my opinion. If I'm looking at a stochastic, I'm not looking at it to interpret the point at which I want to sell at a ceiling. I will use price to identify what the ceiling is. Okay, maybe it's a double top. When you look at this Canadian dollar, you can see in this area we've exhausted before. So it's really the price that I'm relying on that tells me where the layer of resistance is. The stochastic's job as a technical indicator is to confirm that prices are exhausting there. So the initial decision about exhaustion and the expectation of it comes from a combination of the market trend reading and then, in this case, a number of highs in that area. Okay? So consider for a moment that the stochastic essentially is the very last step. I'm not minimizing its importance. I'm just using it at the correct time. So within the context of some sort of system, again, identifying a distribution range is a challenging thing. Okay, I don't find it to be a very easy market trend to trade. In fact, distribution or congestion could be synonymous with confusion. Okay? We know that part of what we're looking for as traders is clarity in the market psychology, and distribution is anything but that. It's volatility and it's confusion. I want you to think about for a moment what a lot of systems look to capitalize on. There's really two kinds of systems. In my experience, the majority of trading systems are either trend following, okay, or they capitalize on some sort of range by either looking to short ceilings and buy floors or looking for breakouts and breakdowns from a range. Okay? So number one, if you buy a system, you've got to know what it's most likely to do. Because a trend following system will think every market's going to continue either higher or lower, while some sort of sideways market system is going to assume every new high could be a buying opportunity if it's capitalizing on momentum, or if it's capitalizing on exhaustion, it's going to think a new high is a good place to fade. Understand what it is it's trying to do. All right? And then realize that all three of those approaches have merit. It just depends upon what? Of course, the market trend, right? It's the market trend. It always is the market trend. So, again, that fascination with indicators and then leading into this idea of somehow predicting the market with an indicator. or this word leading. I don't believe in leading indicators. I think leading indicators can project, okay? But projection insinuates some sort of possibility, does it not? While leading suggests, like walking your dog. Your dog's going to go where it is you walk it if you have a leash, okay? Well, I don't think the markets are like a dog. If anything, they're more like a cat, you know? Slightly more unpredictable. But the idea of leading somehow, again, gives me the visualization of walking a dog. It goes where the leash is taking it. I don't feel that an indicator is like a leash. And I don't feel that you can walk the market anywhere based upon the interpretation of an indicator. So I don't believe in leading indicators, mainly because most indicators, all of them that I know of, require price and calculate the indicator based upon some sort of arithmetic around the high, low, open, and or close. So if it requires price, how can it lead price? That's where the logic fails for me. How can something lead price if it needs price? How about projecting price? You know, I think that's much more applicable in terms of what it is an indicator can do. It's projecting. I'm relying on the stochastic to project and maybe confirm the exhaustion. I'm relying on the MACD to project the momentum, but not lead it. It's the price break. So let's talk about what kind of trader I feel I am and what it is that I rely upon. And I rely upon price. Okay? So that means I'm relying upon a tool that it's probably the most level playing field if you think about it. Everybody sees more or less the same price. Okay? I don't think that everybody gets news the same way. I don't feel that people are privy to the same type of news. Okay, but everybody sees more or less the same price. So it is, number one, a level playing field. So in terms of price and in terms of understanding the top half of a chart, if you will. Okay, let's go to another indicator here while I discuss that. Discussing the top half of a chart. Remember, the top half of the chart, again, it's my opinion, creates this bottom half, this indicator half. Same with the moving averages, by the way. I don't feel my EMA wave, my 34 EMA wave, is leading anything. It's just identifying, projecting where support or resistance might be. Okay? And nobody knows where the market's going, especially not some sort of indicator. We know what the likelihood of a market could be. Okay, I think that goes back to physics, right? Kind of roughly stating what's in motion stays in motion. That's the definition of a trend, isn't it? Why would I want to step out in front of something that is trending up higher or lower and expect it to stop? If it's already in motion, I'm going to assume it's going to stay in motion until an obstacle gets in its way. And on a price chart, what are these obstacles? Other price levels, support, resistance, price levels that are discovered by maybe pivots or Fibonacci. Okay? So these are all the aspects that a system trader, okay? And again, what is a system trader? They're using a method of trading that has more objective entry and exit criteria. Okay? And most system traders will at some point validate these entries and exits, this method, by going back in time and looking at historical testing. Now, there's a restriction to a set of rules, but we can still be discretionary or technical or chartist and still have a set of rules, right? But what a system does is take that extra step and kind of take the steering wheel out of our hands. We still know how the car works. At least we should. We still know how to shift. We should. But now we're just letting somebody else drive the car for us, in this case, the system. I think a lot of times people jump to systems trading without understanding, again, that it's discretionary and price action understanding and technical trading all are the components eventually of a system. If you don't understand those components, how can you design a system? How can you restrict yourself to a set of rules if you haven't defined what those rules are based upon price action understanding, technical indicators, even a little bit of experience. Okay? So the trust that you have in a system, whether it be one that's based on an indicator, whether it be one that's based on chart patterns, whatever it is, to me, one of the fatal flaws in buying a system is that you were not part of that process, and those beliefs may not be yours. The beliefs that guide the system, the rules that guide the system, they may not be your beliefs and guidelines. How long can you follow beliefs and guidelines that, one, you may not even know of if it's a black box, or two, you weren't part of the building process if it was a gray box, right? How do you trust it when you weren't part of the building process? And that's always been my challenge. You know, for me, okay, someone tells me a system works, but if I don't understand why it's working, what environment it's supposed to be working in, etc., I'm going to quickly lose faith in it. Okay? So, sure, historical analysis is fine, but you have to understand why the system was triggering off trades going back in time. Trend following, breakout, breakdown, exhaustion. You know, what was it? Okay? I think trading multiple systems in a market, or even better, understanding which system thrives in which market, can allow you to take an aspect of discretionary or manual comprehension of the market and say to yourself, well, I'm looking at the daily chart of, for example, the euro-US dollar, and it's trending higher. The wave is moving up higher. We have green grab candles. Those would be my tools, or my technical tools, right? And I would then say, okay, with this understanding of a trending market, perhaps I'm better off putting a trending type approach system to work. Again, I'm not predicting anything. I'm just projecting the likelihood that what's in motion will continue to stay in motion. Yes? Okay? Until it no longer does. You know, let's use an example of what was happening in the dollar yen, because last week we talked, I believe, some about what my opinion of the yen was. And because of the Dow trying to roll over, and my feeling that the Dow and U.S. equities had transitioned into distribution, and because the dollar was weakening, I had a feeling that as we were congesting into this pennant, this large triangle on the daily dollar yen, that my opinion was there was more likely a situation for exhaustion unless prices could find footing above 83. So I could either sell into resistance, or the likelihood for a breakdown and a move lower through support. Now, who knew the yen was going to be affected by a completely unforeseeable, unmeasurable, unpredictable event, an earthquake, right? I think that the yen would have sold off regardless. It would have done so in a certainly less volatile way based upon the price action in the Dow. Okay, now we're seeing a lot of different price movement based upon G7 meetings, talk of intervention, too strong a yen. You know, anytime a pair moves from basically 83 to 77 within about 4 trading sessions, there's going to be concern, especially from a country who doesn't want the yen to strengthen much more. In fact, the yen was starting to really stabilize above 80, and the BOJ was comfortable with that. We basically spiked down to 77, and there was cause for concern. We're back above 80, by the way, actually back above 81. All right. Is there an overall downtrend in the dollar yen? Yes. No matter what the intervention is, I don't know that it's going to reverse that. At the time, before the breakdown, we were trying to congest, but I think we were heading towards a breakdown anyways. Okay? And we basically, as I said, accelerated based upon unforeseen circumstances. No one can predict an earthquake. Okay. What'll be interesting now, and this is where the dollar-yen bear in me says, all right, we've taken back, we're basically back to zero. All right, we're basically back to zero. I remember, it always reminds me of back when I was playing volleyball in high school, and if I had a young player, I was the setter on the team, which basically meant I was kind of like the captain of the team, kind of the general of the team. And whenever I had a young player who was getting ready to serve, and we were late into the game, but it was tied up, say it was a 14-14 or 15-15 or, you know, a game within the match, I would go back and tell them, hey, we're back to zero. You know, this is a 0-0 game. Just relax. Well, this kind of reminds me of telling myself that regardless of what's happened over the past 3 sessions, as of right now, this is back to being a 0-0 game. The earthquake was discounted, the market moved lower, and now we're back to the pre-earthquake levels. And please don't confuse my discussing these events, you know, in a very kind of black and white way. This is financial talk. You know, if we were going to talk about the circumstances that are affecting the Japanese people, it's a completely different conversation. I'm talking about these in just a black and white, just financially based way. Because again, what happened abroad is it's very tragic. You know, it's amazing how the people who can at least can afford to be affected by these types of events always seem to be the people who are. So please don't confuse this conversation with my being callous. I'm just discussing price action and events in as unbiased and as purely financial a way as possible without just, you know, getting caught up in the emotion of what happened. Okay? So purely from a price perspective, we are back to 0-0. We're back to a level at which the earthquake has been discounted, a rally has taken us back to the original breakdown level. So now, I think, getting back to the fundamentals and the price action that was affecting this market before the earthquake, we're back to that. Okay? We're back to that. So now the question is, does the yen have the ability to get above 83? And my feeling is still no. Regardless of the fact that we were up 161 points on the Dow today, my feeling still is no. Because when you look at the Dow, we have turned over and we have gone into, I believe, what is a distribution with much more of a bearish look on the market. Okay? Now, how does this all apply to systems trading? Well, a systems trader, you know, depending upon their approach, you know, here we have a market that was moving sideways, a triangle pattern. We broke down lower through uptrend line support. If the MACD was negative, okay, for me, that's a momentum trade. Let's go to the dollar-yen daily. When did the MACD go negative? Let's drop a vertical line here. MACD was negative right about there. Okay? So before we accelerated lower, notice that, before we accelerated lower, we were already in an environment where the MACD was negative. We hadn't even really broken the trend line, or maybe we had just started to break that uptrend line of the triangle pattern. Okay? Let's see if I can pull that triangle pattern up using the IBFX PRS here, so we can go back in time and examine that. Just bear with me a moment, and we'll take a look at that. Okay, so there's my triangle pattern. Okay? So our MACD had already gone negative even before the acceleration lower. So from a momentum standpoint, there was already more bearishness. The grab candles had gone red. We're breaking down lower through the triangle pattern, breaking up trend line support, negative MACD. If I knew nothing else but that, I'm bearish on the dollar-yen based upon the technicals and price action analysis. Add in the fundamentals of the Dow distribution, okay? And then of the earthquake and all the concern that accompanied that, there's your acceleration lower. But my feeling is a lot of times it's unusual how often fundamentals, even the unexpected ones, simply accelerate the current market behavior and psychology more so than reverse it. It's just been my experience that that happens more often than the all-out reversal. Okay. All right. So I've been going on here for some time with kind of a mixed discussion of system, technical trading, where the technical part of my process within my strategies takes place. Okay. And then understanding also to a certain degree some of the fundamentals that can sometimes exacerbate and add volatility to a market. You know, and these are things that can't necessarily be foreseen. Does anybody have any questions so far? Again, I talked a little bit about leading, my lack of really believing in this idea of leading indicators, more about predicting or projecting. You know, to me, a Fibonacci is a projection. I don't believe Fibonacci leads the market. It simply projects support or resistance. So I'm a big fan of projecting. You know, this idea of projecting potential levels of decision. Okay. Are there historical probabilities? Sure. I think everything we do in the market's based upon the fact that usually when support breaks, the prices go down lower. But those historical probabilities, whether it be a chart pattern, whether it be an MACD momentum breakdown, to consider those historic probabilities and a particular strategy without understanding that there are market trends that will make the likelihood of a momentum breakdown more successful when it's coming out of a sideways market than simply a negative MACD and an uptrend line break. You know, think about the fact that a lot of times these probabilities are separate and removed from particular market trends. You know, a lot of times when people look at triangles, they'll test a triangle pattern throughout history without realizing that the triangle, unless it's being applied to a consolidation or congestion market, simply shouldn't have been used to begin with. So to consider it within the context of a trend is not only ill-advised and misplaced, it's to a certain degree from the historical perspective and probabilities unfair. Yeah? Okay. So in terms of the different strategies, the market can go up, down, or sideways. Sideways, it could be in a congestion or consolidation environment. It's my job to figure out which one of the four the market is doing, apply not only the correct, or I think the most applicable strategy, but also the accompanying technical indicator to help me confirm the price action. Okay? So in reality, as I go through this system building process, I won't remove this idea that my system is not ever going to be capable of thriving in every type of market psychology. That would be ridiculous to assume. The trick is, will I be able to use discretion? You know, and this is I don't have the answer to this question, but the trick is for me, will I be able to utilize my wave? And I have a feeling I'm going to pretty much predominantly be using my system on a daily time frame to measure the dominant psychology. So will I be able to use my 34 EMA wave to select which system is most appropriate for a set of time and keep vigil, keep attentive of what's happening on the wave to adjust to another system approach if and when need be. Okay. Question here, do I use swing points in my analysis? You know, I'm not sure what you mean by swing points, like what your definition of that is. For me, a swing is simply a correction. So swing levels for me are going to be looking at the last major rally or sell-off, identifying some sort of support and resistance. For me, a swing point could be the support of the wave in an uptrend or the resistance of the wave in a downtrend. Maybe it's going to be a combination of that and the Fibonacci. So swing to me is simply correction. If you're talking about fractals, no, I don't. Now, if you want to get into, for example, fractals from the standpoint of maybe harmonics and different Fibonacci-based patterns, that could be interesting. You know, the geometry of which I think is interesting. You know, maybe I'm completely missing the point there. You know, again, I don't use fractals. I'm not even that familiar with fractal systems. But for me, what I remember studying is the fractal geometry. And in geometry, I immediately start thinking of people like Larry Pesavento and Fibonacci-based patterns. So if you're going to get into, say, Fibonacci pattern, you know, Fibonacci ratio, pattern recognition type approaches, you know, whether that be like Gartley's 3 drives to a top, or let's see, what else in the geometry world. And it's been a while since I've even looked at these. I did a lot of this, like the AB equals CD, those types of patterns for autochartists when they were developing their you know, a butterfly. Okay, that's another one I'm thinking of. So that to me is about as getting into, I don't even know if that'd be still fractal. I'm probably just digging myself into a ditch the more I'm talking about this. But yeah, as far as I look at fractals and geometry, it brings me back to a lot of what I do with Fibonacci ratios and the pattern analysis that I've read from Larry Pesavento, which is, he's probably the leading authority on that topic. All right, let me tackle another question here. Okay, but thanks for your question there, George. And I apologize. You know, I try not to talk too much on topics that I don't know, and I'm the first one to tell you. I certainly don't know every topic about trading. I've never been the kitchen sink trader, but that's just where my mind goes. So I'm just trying to share with you as frank an opinion as I have about those and where my experience is. Now, another aspect of that pops up into my head, George, and maybe this is probably for another time because it really probably doesn't apply to our discussion here. I'm trying to think about things I've read from Trable. I can't remember his first name, but he had different measurements about swing highs and swing lows and so forth. Now, maybe we're talking about minor highs and minor lows, because when you define a swing point as a high with 2 lower bars, that to me is no longer a fractal. That's just a minor high or low. You know, again, that's what's so difficult about trading terminology. You know, that's why I spend so much time defining what I'm talking about, because I could throw a word out there and it might mean something very different to somebody else. So what you just described there, George, with a high with 2 lower lows or a low with 2 higher highs, higher lows, I call those minor highs and lows. So again, just kind of a difference in semantics there. All right, I got a question from Perry who asks, I'm sorry, but if this is out of context, but should we worry about technicals if you're a scalper? Well, if you're a scalper, again, let's go back to defining what a scalper is. To me, a scalper is someone who takes advantage of momentum as long as the momentum lasts. How do you identify momentum to begin with? Right? What do you define is scalpable? Here I am butchering the English language, but I think that's my license to butcher being an English major. But what's a scalpable degree of momentum? You know? So if you're scalping, for example, what was happening in the dollar yen, I'm sure a lot of people were just simply shorting into that move as it was going down lower. I'm not a scalper, by the way. I think a scalper takes momentum and hopes that it lasts long enough that they can take pieces of that move with the direction of the sentiment and the momentum. So sentiment and momentum are very, very important. I think a scalper would benefit from the grab candles in a way that If they are trying to take advantage of sentiment and momentum organizing in one direction, they keep an eye on the red or the green and avoid blue, in a very basic way. I don't have ideas about scalping because I really don't do it, okay? I've never heard a really great definition of what it is. And if I don't know what the definition of it is, how do I know which market environment to use it within? My definition of scalping is momentum, buying or selling momentum. And if I'm a momentum trader, I'm waiting for a sideways consolidation to break out. So I think momentum trading, the act of getting long at a break of resistance or getting short at a break of support, can lead into scalping if the momentum can continue. But that's the dangerous part, because how long will it continue? At what point, as I keep selling into momentum lower, am I getting to a point where perhaps the sentiment could shift? So again, I'm not a scalper, but I'm not saying that it's not a valid way of trading. It's just not something that I do because it's really not a market trend defined approach, in my opinion. So if I can hear a market trend defined approach that someone can present me, then I can build a plan around it. Okay? Head and shoulders are valid chart patterns. They're very popular chart patterns, but head and shoulders are essentially a neckline. So as far as reversals, I could take reversals from a number of things. Maybe it's a trend line. Maybe it's the break of the wave. I like to, and you're right, Minying, I do like to use a CCI to confirm a reversal. I do. But I wouldn't, as far as the head and shoulders goes, the neckline would have to be fairly steep and supportive of a trend. Otherwise, what am I reversing? If I'm going to play a reversal of a market, it's got to be trending. Otherwise, what's reversing, right? There's a difference between reversal and exhaustion. Exhaustion is getting tired at the ceiling or tired at the floor in a sideways market, while a reversal to me is a trend, uptrend turning into a downtrend or a downtrend turning into an uptrend. So at that point, I could utilize the wave and or trend lines. And the neckline of a head and shoulders can sometimes be steep enough to be considered a trend line. Okay. For me, the CCI, which I was using for visually for a moment on our discussion, is used pretty much exclusively for reversals of trends. What I call a quick transition or a short cycle, where the wave never flattens out to consolidation or congestion, and the market goes really straight from an uptrend to a downtrend by breaking the wave in the opposite direction. I use the CCI to confirm that. Okay. Again, if I was going to systematize that, that's, again, very difficult. How do I systematize a transition like that? These are challenges that I'm running into as I'm looking to find ways to automate my 4 entry styles. For those of you that are joining me for the first time and may be completely lost by our discussion, these are less about just presenting at you, and I want to have a conversation with you. So it might be different than presentations you've sat into before. I really want this to be a discussion. I'm certainly not here to tell you this is the only way to do anything. I think the only thing that any teacher can honestly share with anybody is what they do. Certainly no authority on everything, but what I do know, I have a lot of confidence in, and what I do know is what I try to stick to talking about. So when there's something that I'm not sure about, like fractals, I'll preface the discussion to saying this is how I interpret it and this is my experience with it. Okay? So past recordings are on our YouTube channel, www.youtube.com/interbankfx videos. So thank you for that question. So for those of you that want to know the particular details of each one of my trades, you can check out the YouTube channel. George asked a great question, and this again is going to be part of my system, which eventually this process is the higher time frame. George, I feel, and everybody here in the room, I feel that the daily time frame is the most psychologically significant time frame and that it is the most well watched. So my analysis starts with directional bias. And if you've ever read, if anybody out there has read my Daily Trading Edge updates, at interbankfx.com, you know that I refer to this word, directional bias, quite often. And what it is my attempt to determine what the dominant psychology of the market is by looking at the market trend of the daily time frame. Understand that there may be a trend higher on, for example, the chart of the Euro-US dollar. If there's an overall uptrend on the chart of the Euro-US dollar, I will only consider, for example, short entries on short-term time frames. I don't want to buck the trend on a longer-term time frame. It's a contrarian entry to be short when the directional bias is up. Okay? So in terms of a system and time frame selection, if I was looking for an intraday opportunity on the Euro-US dollar, the 60 and 240 would be limited to potential buy entries. Okay, I got to follow the trend on the longer term intradays. If I'm looking for a short setup though, 5, 15, 30. I will only be contrarian. I will only fight the directional bias if it's a trend up. For example, like we have here on the Euro-US dollar, I will only fight that on a short-term time frame. Okay? All right, let me answer some of these more random questions here, and we'll kind of wrap up our discussion. But I hope you're getting an idea of where I'm heading with this discussion of systems and expert advisors and custom indicators. Really, it's all wrapped up in that same discussion. It starts off with the proper mindset and an understanding of what tools you use when, and an understanding of your own methodology. Okay? So here we talked about particular indicators from a technical standpoint and how they accompany particular trading styles, entry styles. All right? Okay, so the daily chart may not be the most tradable, but it's the one I start with just to make sure I understand what the dominant psychology is. The RSI, Steve, I think can be used in the same type of environment that the stochastic is used in. That's my experience with it. But I prefer the stochastic over the RSI. Just my experience, just my opinion. But it's range bound, sideways volatility. But I've always had better success visually interpreting a